Welcome to Business Over Borders. I'm your host, Leo Tucker. I'm joined today by Matt Steinbrecher, our VP of Revenue here at Reach. Matt, welcome to the show.
Thanks for having me, man.
So I was thinking about businesses that deal with recurring transactions. So they've got some kind of subscription model. So what considerations are there for the, initial transaction where you're actually typing in the credit card and then those recurring billings? Let's break that down a little bit.
For most subscription businesses, whether it's physical goods or digital goods, it's super important. That first time authorization is kind of the lifeblood of their business. So what you want to be able to do is, you want to create a frictionless checkout for the shopper, which may include, minimizing the amount of information that they need to enter in order to complete their order and authorize that subscription, which is more common in the digital space. And then in the physical space, you got to get, your shipping address and billing details, all that good stuff.
Sure.
So it does depend a little bit between the two, but that initial SIT, as we'll refer to it, customer initiated transaction, that's kind of that first time I type in my card details, I hit submit order, and I'm expecting to get whatever, good or service I'm buying. That's kind of the lifeblood for most subscription businesses, because that initial transaction has to be successful in order for the recurring transactions to work properly. So, you got to think about it as the lifetime value for most subscription businesses. It'll vary a lot based on, what they're selling, but it's all based on that recurring business that comes through, not necessarily, a one-time transaction and then you have to reconvert that customer over time. You're really just getting them to subscribe to whatever it is your product is, and then they stay with you for the length of that. So the initial transaction is super important to make sure that you're sending as much information and data to not only the customer's bank so that they understand what is being purchased, but also, your processing bank too.
Right. So we're talking about the initial, the SIT transaction, the customer initiated transaction. We want to make sure we get the right data for that. So that's things like correct billing address, I assume. Obviously, the card data, you have to have that right. Are there any strategies that businesses can employ to maximize the authorization going to the customer's bank, the store's bank, everything? What other pieces of data are there to consider?
Yeah, definitely. I would like a great example is for a lot of digital businesses where, let's say you're signing up for, Spotify or something similar like that.
Mm-hmm.
Basically, you're going to enter your card details, and typically you may just enter your zip code. Not having the full billing address does impact auth rates, and it does depend on what your merchant category code is, so like what types of products and services you're selling. And it does depend on where you're selling to and what kind of banks. But at the end of the day, if you're not able to provide the full amount of transactional data, meaning like the customer's full billing address, all of that information on top of just the zip code, you may see a dip in authorization rates. Now, the flip side of that is by only asking for the zip code, you're able to minimize the amount of information that your customer needs to put in to subscribe to your product or service.
Yeah.
So you're kind of maximizing your conversion rate, but because your first time that first time transaction that happens with the customer is so important to lock it down, you do want to make sure you're monitoring that first time authorization rate to make sure that you're sending in enough transactional data to the customer's bank as well as your bank to ensure that you're maximizing that success rate of the first time authorization.
Right. I feel like I've seen that in real life. A lot of services, especially digital services I've signed up for, I'll show up to the site that says, hey, what's your name? What's your credit card number? The expiration date? Maybe a zip code. It has very minimal information that they're actually collecting. So I imagine it must be a bit of a balance game to let's keep that sign up form as lean as possible, but also collecting enough information to make sure that customer initiated transaction, that SIT, is going to result in being approved.
Yeah, exactly. And that's where it's a balancing act. You got to look at your conversion rate. So how many people actually hit submit order versus what your authorization rate is for those people who do then hit submit order. And balancing that is for sure tricky. And it does vary quite a bit. Like if we're talking about physical goods, it's a different type of ball game where customers know that they need to enter their shipping address.
Yeah, they got to get a product somehow. Yeah.
Yeah, exactly. Whereas when they're signing up for a, subscription platform, or I don't know, whatever it might be, for a digital product or service, then, there's going to be less information required. That does come down to, even more nuance to how the customer's bank ultimately receives the information. And one thing to really focus on, I think what a lot of people don't understand is a lot of the declines that happen with payment authorization attempts come from the customer's bank. So it doesn't have to do with, there is like potential fraud, right? Stolen credit cards and things like that. But it always has to do with, me, Matt, I have a legitimate credit card. I'm buying something online legitimately, but my bank may see some of that data that's passed through in the attempt of the authorization. And they may basically say, even though he's got, $10,000 line of credit with us or whatever, we're not going to take the risk on this transaction. We're to decline it. And I think for a lot of businesses, you want to avoid that notification as much as possible. And by sending that accurate data to the bank, to the customer's bank specifically in the authorization attempt, it will help maximize your conversion rate and your approval rate, which ultimately is, more money in your pocket.
So that makes a bit of sense, because while you may be collecting a little more data, if you can stop that, message from the bank saying, hey, we noticed something weird. You're buying tap shoes. You don't usually buy tap shoes, or, subscription service to tap dancing videos, whatever we're doing in this example.
Yeah.
Trying to avoid that extra bit of friction by, maybe collecting a little more information at the beginning. That does make sense.
So I think what a lot of people that, aren't really detailed oriented in payments, like people who are payment professionals working at a subscription-based company, they may not truly understand that when you send in what we're calling a SIT here, which is a customer initiated transaction, with the intention of rebilling that customer like every month or quarter or year, you're actually telling their bank, Matt is trying to buy your digital subscription product for $9.99 a month, and we're going to charge him every month subsequently until he basically unsubscribes to our product. And so my bank is going to see that as an even higher risk transaction than if I were to just, I don't know, buy like a pair of socks or whatever online for $9.99, just as a one-time transaction. My bank's not going to see that as high risk, because they're like, okay, this is just a one-time transaction. Whereas if my bank is able to see that this is not a one-time transaction, this is going to be a recurring order, they want to really do, and these are all like real-time algorithms, right? But they're basically teaching their algorithm to do enhanced due diligence from a risk perspective on that order, and that's why we call them like a customer initiated transaction that will be recurring, because you're basically acknowledging to that customer's bank, like, you will see us again at a certain, point in the future.
Right. It's not just that one transaction. Yeah.
Totally. Yeah. And so they're going to be a lot more, risk adverse for that transaction, meaning the bank, the customer's bank, simply because of the fact that their risk is now exponentially $9.99 per month for the next X amount of months. If it was truly fraudulent, maybe the person missed it or whatever it might be. But I think that's kind of the key difference of authorization rates. As a result, what you'll see when you're a subscription-based business versus a one-time based business, well, one-time based business will always have higher first-time authorization rates than a subscription-based business. And it's simply because of the fact that the subscription-based authorization is going to the customer's bank and acknowledging that there will be more charges coming. And that's what kind of increases the risk profile of that transaction.
Oh yeah, that's really interesting. So the banks sort of understand their exposure, their risk exposure with a package. Hey, I'm going to send this package. You're only getting the package once. But with a subscription business, it's unknowable. You could have it for the rest of time, and I don't know how long I've been charging my credit card for my Netflix subscription. It's been a minute.
Yeah, and you have to think too about how many people maybe accidentally, a big thing in the industry right now, and why banks are a little bit more, especially U.S. banks, where subscriptions are becoming more and more popular, and banks are becoming more and more limited with their, not limited, but they're starting to shut down more transactions. We're starting to see authorization rates overall are just a little bit lower is really because there's a lot of US customers that are, they get like a free trial, and then you reattempt to authorize that transaction. And now that customer is locked in, but they maybe don't want the product, or they just wanted the free trial, but they forgot to unsubscribe. And so like now you're getting into churn games, which is a whole different side of the transaction, not necessarily like that first time authorization. But it's really important to like talk about free trials and, again, the consumer experience right now in the States in particular, and probably really similar in Canada, since we have pretty similar, I would say, consumer behavior characteristics.
Right.
But what happens a lot is people basically sign up for stuff and then they completely forget they have a subscription. So you'll get ads or whatever on social media. They're like, oh, well, you can sign up for this subscription identification thing where you basically sync up your credit cards to this app, and this app will tell you, oh, by the way, you're paying for these XYZ subscriptions that you probably had no idea you're paying.
Oh, interesting.
And because of that, you're starting to see banks kind of wise up a little bit more if a subscription business is using like aggressive tactics to try and extract as much money off the card as possible, even if the customer's not using the product.
Right. Kind of dark patterns there on the website at checkout, and, small print in the terms of service, things like that. Is that what we're talking about?
Yeah, exactly. Like if you do an annual subscription to a software, for example, most softwares, if I do a billing on January 1st and I'm doing an annual subscription and my next billing is the following January, if I decide to cancel my subscription in mid-February, a month and a half in, because I'm not satisfied with the service or whatever, a lot of people won't prorate your discount. So you're basically like, all right, well, your service runs until the following January as you originally agreed, but we're not going to prorate you and discount you for the, whatever it is, 10 and a half months that you didn't use our product. And then the customer might be upset, so they file a chargeback with the bank, who saw all this data and transactional information. So they understand that the behavior of me as an individual, when I sign up for a annual digital subscription, and I've filed 2 or 3 chargebacks for that type of data, or that type of like authorization payload that the bank has seen in the past of me, they know that like Matt paid for annual Netflix and annual Spotify and annual Hulu, and then charged all 3 of those back over the last 5 years of his behavior. And they're now analyzing that in real time to say, when he goes and buys an annual subscription on a digital SaaS platform, it's pretty likely that he's going to have a chargeback, which means that's hard cost for the bank to deal with the chargeback and go through all that. So they know that I'm a higher risk of doing that, and therefore they're going to shut me down more often as a consumer. And the bank is basically going to decline an attempted transaction on, like, I don't know, Disney Plus.
Right.
But if you do that as a consumer quite a few times, your risk profile to your bank goes up and up and up every time you do a chargeback. So the authorization rate, conversely, for the merchant that's trying to capture your business is going to suffer if you have a higher risk profile to your issuing bank. And that's something, like, again, kind of deep in the weeds of the way that this real-time authorization rate works, but most people don't really understand that that's how it all kind of comes full circle between me as an individual with a credit card issued by my bank and, you as a merchant trying to capture as much money as possible from the credit card issued by my bank.
So, Matt, this whole time we've kind of been talking about US-based businesses. We got our Disney Plus, our Paramounts, our Hulus, and everybody else. Let's talk a little bit about cross-border businesses. So you've got a company who's selling a product on recurring billing, some kind of subscription, but they're selling to multiple markets. Let's say they're based in the UK or they're based in the EU and they're selling into the US, which is quite common. How does that dynamic affect auth rates and ultimately sort of cost of customer acquisition?
It basically just gets more and more complex anytime you introduce cross-border into things. It gets a lot harder to be successful as a subscription-based business. I'll use the example of software and SaaS companies specifically because ultimately software is infinitely scalable across borders. You can sell it anywhere in the world.
Yeah, you're not going to run out of software, yeah.
Totally. But like a physical product, you got to get it through. There's customs brokers, there's shipping, there's time frames for shipping. It's more of a pain. Totally doable. But
yeah,
when we're talking about software where I'm instantly able to access it. I enter my card details. I want to use that software straight away. I hit complete order, and then I get access to whatever the software is. If we're looking at a UK-based business selling to US consumers, the most important thing is, again, to try and maximize that customer-initiated transaction, that first-time authorization request on the US customer's credit card.
Mm-hmm.
And the reason being is because if you're able to get through on that first-time authorization request, it's much more likely that you will be successful on the recurring authorizations, the MITs, merchant-initiated transactions, which would basically be charging my credit card as if I were the consumer on whatever cadence that I, choose, monthly, quarterly, annually, whatever. The thing a lot of people don't understand is why most businesses, like this UK software business, would look at their approval rates or their authorization rates domestically in the UK and would see like really good performance.
Mm-hmm.
They might see like, high 80% to low 90 percentile acceptance rates on the first time transactions, which is really good for, a subscription business. It totally depends on like the average order value and a bunch of other stuff. But
yeah, absolutely. But let's assume good auth rates, 80,
yeah,
90%,
totally. Yeah. Like high 80s, like 88 to like 94% would be pretty good in a domestic subscription business, with a lot of other variables in there. Demographics play a huge key in that. But when you look at your cross-border SIT, your first-time authorization, it's probably going to be like 50 to 60, which is way lower. So when you look at, as a business, your cost of acquisition, right? If you're a software company, you probably have, meta ads, and you probably use Google SEO or Google Shopping or something like that to be able to advertise your business. And you basically are looking at your return on ad spend for the US is going to be lower. And the predominant reason because of that is you're getting people converting. You're getting a US customer to come to your website, go through the checkout, enter their credit card details, click complete order, hoping they're going to be able to access your software right away. But then they get a decline from their bank.
Yeah, but 30% more of them are not, the bank says, sorry.
Yeah, exactly. And it's usually anywhere from 20 to 30% on average.
Oh, that's massive.
And it's huge. I mean, you have to understand that that's like a massive impact to the cost of acquiring a customer successfully. So you'll see the conversion rate drop for those US customers, but then also your cost to acquire those US customers goes up exponentially. Even if it might make more sense, apples to apples, like your cost of converting a customer in the US, just because it's such a drastically larger market, and depends like what your product is, it might be easier for you to actually convert people in the US. But your barrier to entry of getting that return on ad spend that's as positive as it is in your domestic market, like the UK, is this decline rate, right? It's all these transactions that are first times being declined.
Potentially half the customers that you could have in that one market just because of the authorization rates.
Yeah. So if it costs you, let's say, $30 in ad spend to get a customer to convert on your, $69 a month SaaS company, that return on ad spend is pretty good. You get, 50% back, or rather 100% of your investment back within your first month of the subscription. And of course, there's a bunch of other fees that you have, like sales reps and, the cost of your software, whatever.
And such, yeah.
When you're looking at just the ad spend, the cost is, significantly lower if you're able to get those people converting at a 90+% rate when they enter their credit card details. When you're getting a 50-60% conversion when they're entering credit card details, your cost essentially doubles. So that return on ad spend is now going to go from, basically within that first half of that month they subscribe, you get ROI, to now the full month is just your ad cost, because you're getting half of the people, or 30% less or 20% less. But just kind of going through some basic economics, like the unit economics of acquiring a customer, it's much higher. And that's where a lot of people don't understand, like, why are my decline rates lower in these international markets? And again, it always comes back to the customer's bank. If my bank sees me buying stuff, I live in Austin, Texas. If they see me buying stuff consistently here in Austin, and then all of a sudden I'm trying to buy a software that's based out of the UK, and all the other softwares and subscriptions that I have are predominantly US, they're going to see that as high risk. It could be high risk of fraud. It might be that the risk profile of me as an individual, because I always buy subscription softwares and then I end up calling my bank and charging it back because I don't like them or
Yeah,
whatever.
like we discussed earlier. Yeah.
Exactly. Yeah. So it's like, there's all these different things that go into it, but ultimately the biggest one is the fact that my bank is based in the US and I'm using Capital One or Wells Fargo or whatever, and your bank in the UK is, HSBC or Barclays, and that's cross border. So my bank may not recognize your bank. With the larger banks, it's a little different, right? Like JP Morgan's basically the biggest bank in the world. Like their rates will be a lot higher than if I'm using a small Texas-based credit union.
This isn't coming from Austin, Texas. I don't think so.
Yeah, exactly. And it's the same concept as, and I tell people this all the time, it's the exact same concept as if you leave the country, go on vacation to Thailand or Mexico or whatever, you swipe your card and it gets declined. You get a call from your bank that says, hey, did your card get stolen? Was this actually you? Now you call your bank back. They say, okay, great. You'll be in Mexico or Thailand or whatever for the next 10 days. We'll make sure we process all of your requests. That's all happening in a millisecond when it comes to, your transactional data being processed and then crossing borders between these banks. And so if that data is not really thorough, or just the fact that they're two different countries, banks originating in two different countries, ultimately you're going to have a much higher decline rate. So a lot of people look at that and they say, if I were able to get my decline rate to a normal level like I have in the UK, my cost of acquisition would actually be lower in the US. Like my performance would be better in the US, and I'd probably be more successful business in the US, or I can grow my business drastically faster in the US because there's just way more people in the US than there are in the UK. Yeah. And so that's where you see these businesses trying to analyze this, but a lot of the times they won't connect the dots of like, why are my decline rates so much higher in the US than they are in the UK? And it's simply because your bank's based in the UK, your customer's bank's in the US.
What's the fix? That's a big problem.
There's really like one to two ways that you can do this. The first way is if you're a larger company, right? Your Netflixes, your Spotify's, these guys have entities, businesses, operations all over the world. Like they are multinational companies because they're doing billions and billions of revenue every year, getting subscriptions from customers all over the globe. There's a lot of different elements that go into it, but ultimately, how do you compete? Like, how do you get your performance to be better? You can't really compete with someone like Netflix because they're massive. They have the resources to go and put boots on the ground all around the world. Whereas with most of small software businesses that are scaling up quickly, they don't have the resource to go say, okay, well, we know our return would be better growing in the US than it is in the UK. But how do we get that decline rate to go down? Like, how do we get that sit rate to go up or our approvals to go up on those initial transactions in the US? The only way to really do that is to go and create a US entity, to create a US bank account, to now become a multinational corporation. The moment you do that, you have to have boots on the ground, which means employees. You're subject to typically like an income tax that would come from the IRS now. But now you also have employees in the US, which means there's different employment laws. And there's different employment laws across every single state within the US. And so when you think about it as a business owner, you're like, okay, for me to see the return in the US and get the performance results that I want, I need to make a massive investment in basically becoming a multinational corporate. I think a lot of people are a little bit not totally understanding the true cost of acquisition to like actually open a US entity. A lot of people don't understand that, you can go on LegalZoom today and for like $99 or whatever, you can set up a Delaware LLC or a Wyoming LLC. It's super simple. But then as soon as you start moving money through that LLC and you start having employees on the ground and you actually create like a bank account with a legitimate bank here in the US, you now need to have a director who can sign on behalf of the business. Like there's all these additional things that snowball. So it's not necessarily just the creation of the entity. That's dead simple. Most of the time I tell people like at minimum, you're looking at $250,000 investment. When you really add it all up of like, labor costs, man hours, lawyer fees, setting everything up properly. So you're not like overpaying on taxes. And if you don't set things up properly, you're either going to get audited and get screwed, or you're going to end up paying way more than that to your legal counsel to set it up where you're basically optimizing your cash flow between your US and UK entity.
Right. I don't love this plan A. What you got? What you got for plan B? I don't love plan A.
Plan B is you can use a merchant of record, which is basically a reseller, and you can have a distributor like Reach. This is what we do fundamentally, and you can basically use us as a distributor in the US in this example, where we will now kind of resell the product to US customers on your subscribers, rather, on your behalf. And we can get you that performance increase without you needing the entity here. So by us kind of becoming a reseller of your digital good, or this, SaaS company in this example, we give you the infrastructure you need to get the better performance, to get the better ROAS, return on ad spend. So you have that return that you want going into the US, but you don't need to go for that upfront cost. And I think that's kind of one of the biggest things a lot of people miss is, are there other options other than creating that entity structure? And most just don't know about it. But ultimately, there are definitely alternatives just to be able to maximize your first-time authorization rate.
Excellent. That seems much more palatable, especially at the small and medium business size. I'm sure the Amazons of the world and the Deltas and the Netflixes, they can do whatever they want. They can have the tax structure and the team to support filing and entity management, but for, vast majority of the other companies that don't have that kind of capital, merchant of record reseller model is the way to go.
It's a build versus buy scenario. If you're doing $200 million a year in the US as that software company, it might actually make sense for you to have boots on the ground here. Some of the biggest players in the world don't do that, and they don't set this up. And they just deal with those low first-time approval rates as part of their cost of acquisition in a particular country. And so I think that's it comes back to, how can you really maximize your business as it scales up internationally? You have to use some sort of reseller model before you go and build it all yourself. Like it doesn't make sense financially to build it all yourself first as kind of your initial strategy as you expand it. You'll bleed more money than you make in most instances.
Matt, I think we've covered a ton of ground here today. Appreciate you joining us on the show, and we'll be talking to you soon.
Yeah, sounds good. Thanks for having me.
Well, thanks again for joining us on Business Over Borders. I'm your host, Leo Tucker, again. And as always, thanks for joining us. Don't forget to like and subscribe if you thought this content was entertaining, educational, or both. Thanks.
Brought to you by the Reach Network. Visit withreach.com/network for more.